Okay, let's talk about ETFs. They are, without a doubt, an incredible tool for building wealth. But, and this is a big but, there are a few really common, kind of hidden mistakes that could literally be costing you a fortune. So today we're going to break down the 3 biggest errors that so many investors make, and you guessed it, we're going to show you exactly how to fix them.
First up, let's just dream a little bit. Let's talk about the potential here. Imagine you invest just $500 a month. And let's say you get a 10% average annual return, which by the way is right around the historical average for the stock market. You do that for 25 years, and you could be looking at nearly $600,000. That's a real number that shows you just how powerful compounding is. And that's exactly why getting your strategy right from the get-go is so critical. So you're probably thinking, okay, how do I get returns like that? Well, the natural thing to do is to look at the heavy hitters, right? You see QQQ with a 10-year average return of over 17%. VGT is even crazier at over 19%. And even a broad market fund like VTI is clocking in at over 11%. So the temptation is just huge. You want to just grab all 3, throw them in a bucket and think, yes, I've built a supercharged portfolio. But oh boy, that assumption, that leads us directly to our first big, costly mistake.
So here's the plan for today. We're going to tackle 3 key mistakes. First, misunderstanding what ETF overlap even is. Second, we'll debunk what I call the diversification myth. And third, the big one, blindly copying what other people are doing. Then stick around, because we're going to show you how to put all this knowledge together to build a really smart portfolio that actually works for you.
All right, let's dive right in. Mistake number 1, misunderstanding overlap. Now, picking ETFs just based on their awesome past performance, it seems so logical, right? It feels like the smart thing to do. But it can be a massive error that secretly concentrates all your risk, and you might not even realize it's happening.
Let's take QQQ for example. I mean, it's one of the most popular ETFs on the planet for a reason. But if you look under the hood, it's just dominated by technology. We're talking over 57% of the entire fund is tech. And the top holdings? No surprise there. It's the giants. Apple, Microsoft, NVIDIA, the usual suspects.
Okay, now let's pull up VGT, another one of those high flyers, and this is where the overlap problem just slaps you in the face. VGT is 100% information technology. So yeah, QQQ is heavily weighted in tech, but this fund, it's all tech. You're basically just buying the exact same theme, just in a slightly different wrapper.
And when we put the top holdings side by side, well, the overlap is just undeniable. Apple, Microsoft, NVIDIA, look at that. It's the exact same list of companies dominating both funds. In fact, if you look at the weighting, almost half of these 2 funds are invested in the exact same stocks. You're not diversifying, you're just buying them twice.
But wait, it gets even crazier. Let's say you also own a foundational ETF like VTI, the one that's supposed to hold the total US stock market. Get this, a staggering 93% of the companies in QQQ are already inside VTI. So think about that. If you own VTI and then you go and buy QQQ, you're not adding anything new. You're not diversifying. You are just piling on more and more weight onto the exact same handful of tech companies.
So here's the crucial point, and I really want this to sink in. Overlap by itself isn't necessarily a bad thing, not at all. If you absolutely believe in Apple and Microsoft and you want to double down on them, hey, that's a conscious choice. That's your strategy. The mistake is not even knowing that the overlap exists. It's not understanding how it's secretly skewing your entire portfolio towards one single sector, and in turn, cranking up your risk level way higher than you think.
This whole overlap thing leads us perfectly into our second big mistake, what I like to call the diversification myth. This is that old, common belief that just adding more and more funds to your portfolio automatically makes it better, automatically makes it safer. More is always better, right? Well, maybe not.
For decades, I mean literally for generations, the gold standard of investing was this, the classic 3-fund portfolio. The strategy was super simple. You buy some US stocks, you buy some international stocks to get a different flavor, and then you buy bonds because, well, they're not stocks at all. The whole goal was just maximum ultimate diversification.
But here's the problem with that classic model, especially over the last decade. If you actually look at the 10-year returns, international stocks, something like VXUS, only returned about 3.7%, and bonds, like BND, a measly 1.3%. Holding these things has been a major drag on your portfolio's performance. It's a perfect example of what some people cleverly call diversification. Where adding assets just for the sake of it actually ends up hurting your returns instead of helping them.
You know who put it best? The man himself, Warren Buffett. He famously said, diversification is a protection against ignorance. And what he meant was, if you've actually done your homework and you've found some truly wonderful businesses to invest in, it's just madness to then go and dilute your investment in those great companies just so you can add your 30th or 40th best idea, all for the sake of diversification.
So let's just reframe the whole objective here. The goal isn't to have the most diversified portfolio possible. It's not about collecting ETFs like Pokemon cards. The real goal is to get the best possible long-term return with consistency and a level of risk that lets you sleep at night. It's all about quality, guys, not just quantity.
And that brings us to the third, and honestly maybe the most personal mistake of them all, blindly copying what other investors are doing. Just because some portfolio you saw on YouTube is perfect for that person, it absolutely does not mean it's right for you. So after hearing all this, you might be thinking, okay, I get it. I'll just find an expert whose portfolio I really like, and I'll just copy it exactly. But hold on, that misses the single most important factor in all of investing, your own unique personal context.
Let me give you a personal example to really drive this home. Real estate ETFs, REITs, they can be absolutely amazing investments for generating cash flow, but I don't own a single one. And you might ask, why? Well, it's because a pretty significant chunk of my net worth is already tied up in physical rental properties. So for me, adding REITs would just overload my portfolio in that one single sector, and that would dramatically increase my risk, see? This decision is based entirely on my personal situation, not on whether REITs are a good or bad investment in general.
And that right there, that is the key takeaway for this whole section. The single biggest mistake you can make is investing in anything without understanding what it is, why on earth you're buying it, and how it fits into your personal financial plan. That research, it's not optional. It's the whole game.
Okay, so how do we actually move past all these common mistakes and start building a strategy that's truly intentional, one that's actually effective? Let's bring it all together right now.
Here's your path forward. Plain and simple. Step 1, understand what you actually own. I mean, really understand it. Dig into your ETFs, look at the top holdings, and figure out where that overlap is so that any concentration you have is on purpose. Step 2, shift your focus. Stop chasing maximum diversification and start looking for high-quality assets that have a real shot at long-term sustainable returns. And Step 3, the most important of all, build a portfolio that is a reflection of your personal goals, your risk tolerance, and your entire financial life.
So I'll just leave you with this one final question to think about. Take a really hard, honest look at your investments and ask yourself, is this portfolio I've built based on some old, outdated model? Did I just copy it from someone I saw online? Or is it truly, intentionally, and unapologetically built